Assalamu alaikum, my honorable teacher. Myself Mohammad Rifat Ahmed and my student ID is 172. Now I will discuss my today's topic Bangladesh Bank's monetary policy statement. In FY25, the economy faced several serious problems like high inflation made life difficult for ordinary people. Foreign exchange stress created pressure on imports and the value of the money. Falling reserves reduce our ability to handle global shocks. Banking sector weakness, including poor governance and high non-performing loans, created risk for financial stability. To handle these issues, Bangladesh Bank adopted a tight monetary policy and introduced a market-based exchange rate system under interim government in August 2024. Strategic policy objective for FY26. For FY26, Bangladesh Bank has set three clear objectives like inflation control to bring down keep inflation at or below 6.5%. Support sustainable growth to achieve GDP growth of around 5.5%, which matches the government's target. Ensure financial stability by rebuilding reserve, strengthening banks, and restoring confidence in the financial system. In this monetary policy statement, Bangladesh Bank announced that the overall stance will remain tight. Interest rate will be kept steady for now. A reduction in rates will only be considered if inflation falls consistently below 7%. The foreign exchange regime will be more flexible and market-based with a reference exchange rate published twice daily. Bangladesh Bank will intervene only to prevent excessive volatility, not to fix the exchange rate. Interest rate corridor. To control make liquidity and inflation, Bangladesh Bank introduced an interest rate corridor. This corridor has three levels. Repo rate 10%. This is this is the main policy rate used to influence short-term market rates. Standing deposit facility (SDF) 8%. This is the floor rate which encourages banks to deposit excess money and with the central bank. Standing lending facility (SLF) 11.5%. This is the ceiling rate which allows banks to borrow from the central banks if they face liquidity shortage. This system helps guide market interest rate within a fixed range which keeps demand under control and shows Bangladesh Bank's strong commitment to fight inflation. Oper- Operating framework and tools. Bangladesh Bank is now following an interest rate targeting framework. Monetary aggregates like M2 and are used only as indicator. To implement this framework, several tools are being used. Policy rate adjustment through the corridor system. Open market operations such as repo, reverse repo, and Bangladesh Bank bills to manage liquidity. Liquidity ratios like cash reserve ratio, CRR, and SLR. Foreign exchange operation to smooth volatility. Targeted refinance scheme for a specific sector if required. Monetary and credit guidance. For the first half of FY26, private sector credit growth will be calibrated to make sure monetary policy is transmitted effectively through market rates. Broad money and reserve money growth will be set in line with the goal of lowering inflation. Bangladesh Bank will also keep close coordination with fiscal policy to prevent excess demand in the economy. Banking sector reforms. To strengthen the banking sector, Bangladesh Bank is introducing several important reforms. Governance improvements, strict rules against weak boards and related party transaction, asset quality review. International funds have been engaged and 17 banks are under review. Bangladesh Bank Resolution Framework. The Bank Resolution Ordinance 2025 has been finalized. The Bank Order 2025 is under review and a special resolution department has been created. IFRS 9 migration. Bank will move to expected credit loss provisioning by 2027. External sector and FX policy. A stable external sector is very important for economic resilience. Bangladesh Bank foreign Bangladesh Bank's foreign exchange policy for FY26 is based on three main points: flexible market-based FX regime with a twice daily published reference rate, target in target intervention only to prevent disorderly volatility and rebuild reserves, reducing imported inflation by limiting how global price increases affect domestic inflation. The goal is to create a resilient external sector that can absorb shocks from global markets. Risk and vigilance. Although the policy is strong, there are still risks. Domestic risk, political uncertainty after election, high non-performing loans, and slow private investment. External risk, tariff shocks, slower global growth, and unstable energy and commodity prices. Transmission risk, if banks' balance sheet remain weak, interest rate changes may not fully influence the broader economy. This risk means that Bangladesh Bank must remain very cautious and vigilant.